afternoon, everyone, and welcome back to our monthly session on currency outlook. We have entered the new financial year, and there are. Hello.
Yes, Samir, you can continue.
Yeah, sorry. Yeah, so we have entered this financial year, and there are a lot of interesting things lined up. We just saw the Indian monetary policy where they halted the interest rate hike, and we saw some dovish stance on the US front also, even though the US and the euro they increase the interest rate. But it will be interesting to see what happens going forward. We have with us Mr. Dilip Parmar. He's from the research team who takes care of the currency segment. And he will guide us today on how we can look forward for this various currency segment pairs. So over to you, Dilip bhai.
Yeah, thank you, Samir bhai. Uh, so, as Samir bhai has already told that new financial year has been begun, and we have seen that policy divergence has been happening in the developed markets and Asian market. As we can see that our RBI has started posing interest rate and indicated that the inflations will cool down in coming months. While at the same front, what we have seen that the US has raised 25 basis point hike, but the way the banking crisis has happened in the US make the central banks to think about the policy tightening, and probably we might see that going ahead by the year second half of the year we can see that the Federal Reserve also start pausing the interest rate. However, they have also indicated that all the decisions will be data dependent. But looking at the financials and banking crisis, we believe that the Federal Reserve might hold the rate uh, where it is, and that would be probably the positive for the risk assets and negative for the dollar index, as we so that the interest rate differentials will start again playing and the carry rates will be stabilized. So this time this one so far we are a couple of things which we are going to discuss. Starting start by the month, what we have seen that the dollar index has again came into the pressures, as we have seen that the US few of the US banks has almost near to defaults level, while at the same time what we have seen that the Japanese currency also depreciated. The reasons being that the new appointed governor has continued their stance, and again they have indicated that the yield curve control measures and all those things and stick to the lower interest rate, and also indicated that the inflations might come down, as we have seen that the in last couple of months commodity prices has started declining along with the employment being the state on a stable front. If you look at on the rupee side, what we have seen that the rupee has marked the positive months again, and if you look at the last month, we have seen that the 0.42% gain, which is the second best performing currencies in the Asian basket. However, for the YOY basis, we are still down by almost 7%, and in last 6 months, we are up by 1.1%. If you look at on the Asians front, that uh, Chinese currency depreciated, while the Swiss franc also, that is the safe haven currencies that declined along with the dollar index. What we have seen that the Brazil and Australian currency started improving, as the Australian central banks has also started the cutting the rates. This was the major price actions for the currencies concerns. What we have seen that the mixed set of numbers in the currency among the major pairs, which what we have seen that the euro and pound, which was under pressures for the last couple of years, have started improving. And what we have seen that the last month euro appreciated almost 1.6% and pound 1.9%. So both the currencies have started gaining the momentum on a positive side, and technically it is also started well positioned on the on the commodity front, as we have discussed that the gold has made an all-time high of 2085 in the this month itself, and last month the closing was 1990. Same way, the silver was up 4%. Currently, it is quoting more than the previous month's close. Among the risk asset sides, what we have seen that the our market started outperforming as the flow started moving from China and other Asian markets to the Indian markets, and what we have seen that almost 2 billion kind of inflows has been seen in the Indian equities. Apart from that, what we have seen that the debt market has also started improving, and what we in the month gone, or we can say in the last quarter, somewhere around 200 billion kind of inflows were there in the bond markets, and 2.5 billion kind of inflows in the equities so far this quarter. So all in all, as the FI backs the back in the secondary market, the impact has been seen in the rupee sides, and what we have seen that the rupee has started appreciating after last year's pathetic performance. So all in all, the majority of the Asian markets were on a right side in the month gone. This week this times what we have a discussions related to the inflations, interest rate, what could be the path for going ahead in the US banking sides. So all these are the point of discussions for this one. As we can see that the commodity prices has started falling, and uh, what we have seen that the this time, due to the rain, what we have seen that the summer heat was slightly on a lower side, and that has impacted the food prices, and what agri commodity major agro commodity sites vegetable prices has declined. Along with that, what we are seeing that the industrial growth has been improved. So all in all, what we see that the inflation starts against on a falling side. Apart from that, what we can see that the going ahead, this month's number could show that the due to the base effect, the inflation's number may come slightly on a lower side this month, and the what we expect that the inflations could remain between 5 to 6 in coming months. So that could given support to the RBI's policy of keeping the stance, or keeping the policy rate unchanged for the again in the next meeting also. So that is the positive sides, and as we said that inflations could come down due to the base effect and the lower vegetable prices. Back to the US side, what we are seeing that the on a left side you can see that the tighter credit conditions has created a position created some kind of a softness in the prices, and we can see that here the small business prices has started falling from the level somewhere around 2.4 to currently it is somewhere around negative on a 3 side. So same way, expected conditions and actual credit conditions has been showing that the conditions could be on a lower side, and that will bring down the US inflations on a lower side. So here is the Philip curves. On a left side, you can see that the inflation's percentage. On a x-axis side, you can see the unemployment rate. So the Phillips curves also indicating that the inflations and the unemployment, both the rates can come down to the level of 5%. So that will ultimately come near to the our, Federal Reserve's mandate, and we can see that as the inflation cool downs and job markets get stabilized, there are higher chances that we may see that the Federal Reserve starts posing interest rate and may come to the pivot by next year. Again, this one is the again the probability, or you can say the Federal Reserve's interest rate curve. What you can see is that the blue dotted line is the latest one, uh, 1 week before the sky blue dotted lines, and gray dotted line is on a month ago. As you can see that the recently what we have seen that the slope has been on a downside, just because the market has started pricing in the lower rate going ahead, and as discussed, next year we can see that the Federal Reserve can come to the pivot side. And as you can see that the dotted line has been indicating that there could be one more hike in upcoming meeting, and then we can see that the post for the time being. Here also we can see that the implied Fed rate versus the FOMC market outlook. As you can see from the dot charts, we can see that the rate is going to be on a lower side. Again, if you look at the European side, the scenario is slightly on a different side, and what we have seen that after 0.25 basis hike in the ECB front, again there could be chance that in the July meeting we can see again one more 25 basis point hike, and then we can see some kind of a flattishness. However, the as shown in the dotted chart, the expectations of higher rate is still there for on a European bank side. This week we have a Bank of England policy meeting, and almost 25 basis point hike is projected and priced in. But as you can see that the Bank of England is still far from the other banks, and as you can see that the curve is indicating that it may get post somewhere around 4.75 to 5 side. Uh, Here we are seeing that the 3.75 could be the level where central bank ECB might think about the holding the rate, but the cycles may not pick out somewhere around 3.75 as the interest rate difference between Federal Reserve and ECB is still there are some 200 basis points. So we expect that the divergence can be there between the US and the European countries. uh, this is the perfect you can see the chart that there will be the divergence could be as the policy meetings comes, and as the time passes the divergence between ECB and Federal Reserve to widen, and this wideness can be seen up to the January 2024 and beyond. So the policy divergence will be there in the between the ECB and Federal Reserves. This is the debt cycles as we this is the one of the important points from the historical perspective and from the recessionary side. So what we can see that the debt ceiling has been about to reach in the June by June, as the Janet Yellen Treasury has said this week. So if the debt ceiling reached by the June 23, then that could be the probably the some kind of uncertainty or some volatility is expected to be in the bond markets, and that may uh, create some extra volatility in the other assets classes. So next few months would be on a slightly on a volatility side, and one should keep eye on the bond market as the bond volatility is at extreme level, just because the US historically debt ceiling is going to reach by the June. So that will create an extra volatility in the bond market as well as on the equity sides and forex sides. As the yield, as I mean, the inversions has been happening in the shorter term and medium term treasuries at the US front. Uh, this is another points of our discussions, as we discussed that some of the US regional bank has started falling, and some kind of a panic has been seen. You can see that the European bank is relatively stable and more stronger than the uh, US bank. So that is clearly uh, see from this chart, just because the last 1 year chart, if you look at the performance of the US bank is on a downside, while the if you look at on the S&P 500, it is almost on a flat knot, while the European bank is still on a upper side. So that is indicating that the European banks are still on a stronger side, while US regional banks and large banks are on a weaker side. Uh, Before moving into the domestic currency pair, let's look at on the global front. As you can see from the chart, the dollar index is having a multiple bottom somewhere around 100.80 kind of a things. And what we have seen that in the last uh, uh, dozy of last month, uh, sorry, we have seen that the dozy candle in the last week of the April months, and that is indicating some kind of a pause or indecisive in the markets. Looking at the pattern formations, we recommend one should go short only and only below 100.80, that is the dollar index level. The sharp selling can only be seen only below 100.8 8 level, so that we may see some kind of a short covering bounce before falling. As we see that the directions of the dollar index still on a downside, there could be possibly that here we see some short covering bounce, and again then we can see that the selling momentum can start. So for the time being, we remain on a neutral sides for the dollar index, and we will wait for the level of 100.80 to break on the dollar index sides, or we can see that there's some kind of a short coverings some to the level of 104 kind of a level. Then one can think about the going on a short side. Again, back to the euro side. Likewise, what we have been seeing that 1.11 is the strongest resistance we have been witnessing in the euro, and as you can see that since September, the euro has shown a vertical up move from the level of 0.96 to the almost 1.11, and the over bullishness and the CFTC positioning has been indicating that we can see some kind of a pause in the uh, euro, as the fundamentals do not indicate that sustainability of a 1.11 levels for the euro. We expect that the one should remain on a cautious side, and whosoever is having the positions on a longer side in the euro, we should book a profit somewhere around 1.1 and wait for the time corrections, and then we again re-enter on the bullish side. As the trend is still on a bullish side, we are not recommending any on a short side, but recommending booking profit or going long only through the option side. GBP has given the fresh breakout. As you can see that we have seen that the flag pattern formations, and the breakout has came somewhere around 1.25, and that is the clear cut breakout, and the pattern targets are come somewhere around 1.30. So in the pound, we recommend going long on any dip for the target of 1.30 and then 1.35. So among the major pairs, the clear cut buying has been seen in the GBP is GBP against the dollar is answer. One more breakouts what we have seen in the uh, USD JPY. So JPY has started depreciating after the recent Bank of Japan policy meeting, and what we have seen that the first sign of some reversals in the JPY. One of the resistance we see somewhere around 138. Once the level of 138 crosses, the higher high formations will be confirmed along with the higher lows. So for the yen is concerned, there is a negative outlook going ahead, and level of 138 could be the near-term resistance. And once the level of 138 crosses, we can see the pair move towards the level of 150 odd levels. We can see that the oscillators have also started giving positive crossovers, and we can see that the MACD start trading above zero line. Back to the USD INR, as you can see from the chart since October, we have been in the range from 83 odd levels to 81, and the direction is still on a lackluster side, low volatility, low carry, some kind of a lackluster markets has been seen. What we see that the central banks interventions in the markets and continuously buying dollar at lower level, making difficult for the traders to go on a directional side. So for the next month, uh, as we lag the directions, we recommend selling 80 to 50 to 83 call, and same way selling 81.50 to 81 put. So this is the broad range in which the USD INR could continue to trade. uh, uh, the directional traders, we believe that 81 could be the difficult level to break, while on the same way 83 could be the difficult level to cross. So we still believe that the range which has been started from the October month, the same range can continue for the this month as well, and one should wait for the directions trend only and only the range breakout. Uh, Again, on the euro front, as we have discussed, the euro is placed on a stronger side against the dollar, but the fundamental aspects of the euro is still not a clear side or on a weak side. On a rupee, against the rupee, the euro is still on a better side, and it has already crossed the level of 90.60. And looking at the overall chart pattern, we remain on a bullish side for the Euro INR. However, we believe that one should create a long position somewhere around 89 kind of a level, where the risk reward ratio will be favorable. uh, we recommend somewhere around 89.15 kind of a level, where is the 10 days exponential moving average. There one can create the long positions with the stop loss of 87.90 kind of a level. So we remain on a bullish side for the euro INR. However, the higher side is also capped somewhere around 91.70 and 93.50. 93.50 is the multi-month and multi-year high, so that will act as a strong resistance for the euro INR is concerned. Back to the GBP INR, as earlier also discussed that GBP is very well placed against the dollar, and but this week we have a Bank of England interest rate decisions, and probably we see that the 25 basis rate point hike, 25 basis point hike in the meeting. But the way the thing has been happening in the uh, British side, there are chances that we can see that the GBP INR can continue to move a higher side. And technical pattern target immediate resistance come at 103.50, and the crossing of 103.50 will open the space for the 105 and 107 kind of a level in coming months. As we see that the yen is on a downside, and the yen is having the immediate support somewhere around 59, and breaking of the 59s will lead to the selling towards the level of 57.23. So we recommend selling in the JPY INR with the target of 57.20, and keeping the stop loss somewhere around 62 odd levels. Going ahead, this month we are, as we discussed, we have a Thursday we have a Bank of England policy meeting. Apart from that, there are the routine inflations and GDP data which will drive the forex market volatility. One should also keep eye on the US debt ceiling, US uh, uh, treasury yield curve, and risk assets for the directional trend in the forex market is concerned. Volatility is still on a lower side for the USD INR, so the buying of a options might not give you the better returns in the USD INR is concerned, as the low volatility is expected to remain here on. And so the option seller might be on a positive side for the what we can say in the USD INR, while in the other Euro, GBP and JPY expected to remain slightly on a volatile side, in particularly GBP is concerned. So this is the basic disclosures, and thank you all for giving me time and hearing peacefully. Over to you, Samir bhai.
Dilip bhai, thank you once again. Very in-depth presentation, to the point, very crisp. But like what I can gather from your presentation, going forward for the coming month, the US debt ceiling in the month of June is one event which we need to watch, and the bond market definitely will give a lot of insight going forward. Currency market looks little volatile on the euro and the GBP front, but more stable on the USD INR front. If somebody wants to trade the currency segment, the exchange traded currency segment, the very simple way to get connected to the currency derivatives is you log into the website of HDFC Securities, and under products there are currency derivative page. Client just simply needs to put across a simple financial documents to register, and they can start with currency derivative. We have in-house research. We just heard Dilip bhai. He provides a lot of in-depth present research on currency on a daily basis. There are what a lot of trading calls which we generate. There are special calls occasionally when there are opportunities. So one can avail that also once they log in and once they probably become a part of the HSL family in currency segment. Uh, We'll be shortly launching our currency derivative on our new mobile app, Invest Right also. So that is just around the corner. Probably in a month or so, we can have that currency trading on mobile app, which was long awaited. So that is one of the bright thing which is what we are offering to the clients. So that will be one of the most important things to be awaited. So that's all from our side. I think if anybody has any questions, they can put in the chat box, and we will be more than happy. Uh, as we have some time, so we can probably take some questions, and maybe we can address that. Yeah, I think so. Probably, I think we are done. There is not much on the further thing. We'll once again reconnect next month with once again bringing what happened in the month of May and what lies ahead. Interesting times, especially the first quarter where this US debt ceiling will provide a lot of insight. So that's it. Thank you all for joining us. Thank you, Dilip bhai,
Thank you all.
for the presentation.
Thank you,
Thank you so
Samir
much.
bhai, and thank you all.
Thank you all.